Today's conversation is sponsored by First Generation Capital Partners.
I sort of stopped having that feeling. I didn't want to be any higher in the organization than I was. I didn't want that next level of responsibility or that leadership role. And I saw the people that were in it, and I didn't want their lives.
You're listening to the Going Long podcast with Billy Keels, the #1 podcast for long-distance real asset investing.
Welcome to the Going Long podcast. We're back once again to continue to help to educate you so you feel much more comfortable as well as confident investing beyond your backyard. And yes, I'm your host, Billy Keels, back once again for another amazing, awesome, fantastic, just extremely actionable conversation. Today's guest, you are absolutely going to need to get your pen and pencil out because he just shares all the good stuff. So before we get into the conversation, though, I just want to continue to say thank you for tagging us, for sharing across social media on the LinkedIn and the Instagram platform specifically. Really appreciate that. If you want to leave an honest written review as well as rating, we made it really simple for you. Stop thinking about it. Just go ahead and leave it. And if you need to click on the link, there's a little video that will share exactly what you need to do. Also, if you want to listen to any of the previous episodes, because there was just that one episode that you know that you wanted to listen to, or a friend of you told you there was a certain person on the podcast, go to firstgencp.com/podcast, and you can find every single episode we've ever done. You can find the audio, the video, the transcript, find it all. firstgencp.com/podcasts. And listen, if you're someone who's been in a corporate career, you know inside that there's something that's happening. You don't know when is when, meaning that your corporate is going to become optional, that you are moving into something else to really claim your life's priorities, life's purpose on a higher level. Like today's a conversation that you are going to want to listen to all the way until the very end, because we've got a guest who went to a pretty amazing university. We'll talk about more of that. You're going to understand why I talked to you about that. And we're going to get into the conversation that we have with the founder and owner and principal of Red Hawk Real Estate, Mr. Paul Shannon. We're going to get to that just after this. So you know what? If you've ever wanted to understand how serving others as a corporate sales leader and consultant can lead to a Red Hawk long-distance investing journey successfully, then guess what? Today's a conversation you're going to want to listen to until the very last word. I promise. You know why? Because today's guest not only started his corporate career and as in the consumer goods industry, he also then had roles as sales leader and consultant in the healthcare industry. And I think that was probably something that's been amazingly just successful, and I want to hear more about that. He also has a proven track record of overachieving in his Midwest region. I'm a Midwest guy, so hey, there you go. He started his success in real estate back in 2016, and that led to 2019, him actually leaving the corporate world behind. And today he's focused on achieving successful outcomes for himself and others in both active as well as passive investing. It gives me great pleasure to welcome to today's conversation the principal and owner of Red Hawk Real Estate, Mr. Paul Shannon. Paul, welcome to the show, man.
Billy, thanks so much. I appreciate having me on today. Looking forward to our conversation.
You and I both, man, this is a long time coming. I'm happy about this one. So, maybe you'll tell it. If not, I'm going to tell something about why this is actually an even more special conversation because of where we went to university. But anyway, so here's the thing, Paul. You know I'm going to ask you a lot of questions, man. You're going to get 2 in the beginning. You're going to get 3 in the end. You're going to get some in the middle as well. But the thing is, I would like for us to get started, and I don't want to even ask you the first question unless you tell me you're ready, man. Are you ready?
Let's go. Green light.
All right. Green light. So help us understand, first and foremost, where do you call home in the U.S.?
So I live in Indianapolis, Indiana, in the Midwest. I've been here 9 years. I'm originally from Boston, Massachusetts. I relocated to Columbus, Ohio when I was 13, went to high school there. That's kind of how I ended up at Miami University in the southwest part of Ohio, where I know you're an esteemed alumni as well, Billy.
Yes.
So there's our connection, the Miami Red Hawks, although they've been renamed since you graduated. You're a little bit older than me, I guess, aren't you?
Yeah, I am. Don't tell everybody. Come on, man.
So I bounced around a little bit. I moved back to the Boston area when I was in my 20s and early 30s, got married, and then we moved back to the Midwest. We kind of aligned with the values here. We thought we could get ahead a little bit faster because it's a little bit less expensive to live here. Mm-hmm. Ended back in Columbus and moved to Indianapolis in 2014 and have been here ever since.
All right. Fantastic. So Indianapolis is home today. And help us understand, Paul, you know I love positivity, man. So what is the most positive thing that's happened to or for you in the last 24 hours?
Man, it's an easy one today, Billy. Yesterday, we inked a deal. Me and the Left Field Investors Group. We signed the final copy of our private placement memorandum and our operating agreement to start a fund called InvestWise Collective. And we're going to be hopefully bringing some really exciting risk-adjusted opportunities to our investors here really, really soon.
Fantastic. And well, since you mentioned the guys, so Left Field Investors, a lot of very, very quality content, wonderful community. And thank you very much for sharing that, because it's always nice to hear when Jim and the Pounders and connecting with awesome people like yourself and continue to do positive things. So really appreciate you sharing that, man.
Absolutely. Yeah, the Left Field Investors are a fantastic group. They've really made some strides in the last couple of years. And if you're a limited partner already and you haven't heard of them, you need to check out leftfieldinvestors.com. And if you're kind of sitting on the sidelines or looking for, opportunities to get away from traditional assets and into some hard assets, into some real estate in a passive way, that's a great place to start from an education standpoint, networking, vetting sponsors, a fantastic platform.
Yeah, I was just going to say they do such a great job of, not just on the education side of things, but also too from a building community and doing it in such a way that is so positive, and also being able to get a better understanding for whether you're a beginner or you're a seasoned investor. There's really a way to continue to grow and to continue to get involved in whatever way that looks like for you through that 100%. Community. So yeah. So and big shouts out to Jim and the co-founders over there. So here's the other thing, Paul. Most people, everyone that is part of the Going Long family knows that I'm a recovering perfectionist. So I kind of do things sometimes that are not really possible, like telling your entire backstory. And maybe today was like 2.5 seconds, probably that Miami connection thing. But that was going to be impossible. And I tried to do it anyway. So I need your help, because this is like this gene that just does not work. But if you could tell your backstory in your own words, Paul, and then also if you could help me out, man, one of the things that would be great is if you could talk to us about some of the major decisions that you've made to get to this point in your journey, and then we'll see where you and I take the conversation from there.
Absolutely, Billy. So, when I graduated college, I got into sales. I was a marketing degree graduate and really didn't know what I wanted to do when I grew up, essentially. So I was a good people person. I enjoyed networking and trying to help others. So sales is kind of what I naturally gravitated towards. And I spent 16 years in sales. For the back half of that time period, I was in medical device sales. I was selling the capital equipment and implants that are used in cataract surgery. So I was in the operating rooms early. I was helping surgeons implement technologies that were new to them, helping them kind of discover ways to improve their patient outcomes. And really enjoyed the people I worked with and got a lot of benefit out of it personally. But what started to happen was I started to have kids, and I was really traveling a lot more as roles and responsibilities evolved and changed. More fell on my shoulders. I was overnight in hotels towards the end of my career, about 80 nights a year. I was working 60 to 80 hours a week, depending on the week. Some of the weekends I would be leaving on Sundays to get to where I needed to be for an early Monday kickoff. And I just kind of realized that my values weren't quite aligning anymore with what I was doing in my day to day. So I was looking for a way to kind of escape the rat race, if you will. I was always pretty conservative with my finances and tried to save as much as I could to give myself options. And I kind of saw real estate as a way to diversify away from traditional assets, provide some supplemental income to slowly replace the income that I had from my career. And there was also upside too. If you invest in value add real estate, not only can you capture some of the income, but you can use the money that you have and you can sort of recycle it in and out of deals. You buy a property that needs to be fixed up, you rehabilitate it, then you fill it with a tenant, you refinance it, and you just continue to do it over and over again. When you refinance, that capital comes back out of the deal, and then you can deploy it into a new one. And that first deal continues to produce income. So that's the BRRRR method in a nutshell, really. And I started to do that back in 2017, 2018, albeit slowly, because as I was working so many hours in my corporate job, I didn't really have the time to dedicate to really scale that well. But I was also taking it slow just so I could kind of figure out, hey, is this something I know? Do I know what I'm doing? Am I doing this right? And had some success. I did about 3 or 4 deals like that where I was able to recycle 100% of my capital out, fill these properties with tenants, and then have the residual income coming in. So at that point, things had really gotten to it came to a point, when you know, and I was ready to leave my career at that point. I took the leap, and that was in 2019. And that's when I really started aggressively acquiring single family. My strategy kind of changed a little bit when the Burr method was no longer working in Indianapolis. I was not being able to recycle 100% of my capital out, and I had a finite amount of capital that I was willing to deploy into real estate. So I started to look at different tertiary markets around Indianapolis that were within driving distance, so I could still maintain some level of control and oversight. But I looked at like areas like Toledo, Ohio, Dayton, Ohio, Fort Wayne, Indiana, and eventually landed in Evansville, Indiana, which is 3 hours south of Indianapolis. And why I tell this is because that was really the catalyst for me being able to scale my business at a much greater degree. And why I was able to do that was because property management was really the anchor that was holding me down. I wasn't able to really move fast enough because I was constantly dealing with lease ups and tenant issues and maintenance and contractors. And I was really heavily involved in wanting to be at the asset and looking at it and making sure everything was okay. I was a micromanager, more or less. So when I went to Evansville, I built a relationship with an individual down there who eventually has now become my partner in deals that we do in that market. But he was a property manager with somewhere between, 600 to 800 doors under management at that time. He was an investor himself. He was a young guy, so I knew that there was a long track record of potential that we could create. I bought a house at auction. I turned it over to him, gave him the plans of how I wanted to rehab it, gave him a budget. He hit that number. He filled it with a tenant. That tenant is still in there today, and that property is still cash flowing. And we were able to achieve the Burr, where we were able to recycle that 100% of that capital back out. So that was kind of the start of our relationship. And since then, we've done probably close to 100 rehabs together. And that's in both single family as well as multifamily. As I started to kind of mature in the business, I graduated from single family, if you will. I still do flips and I still like single family. Actually, this year we're doing more single family than we've done in the last 3 or 4 years. But I got into multifamily. We did a 40-unit building down there together. That was pretty much a disaster when we took it over, but a true value add where it was about 70% occupied, classic units from the 1970s, some tough tenants in there. And we just basically use that same Burr method that we have been using with single families and implement it with the multifamily properties. So did that for a few years. Multifamily's kind of gotten a little bit tougher to make the numbers work on as cap rates kind of compressed and now interest rates have gone up. There's a pretty wide bid and ask spread. What sellers' expectations are kind of from maybe a year or two ago, where buyers have kind of adjusted the new norms of the capital markets. There's not as much yield to potentially get in multifamily. So we've kind of sat on the sidelines a little bit over the last, call it 18 months. As I mentioned, we've got a little bit more into single families. But during that time too, to keep busy, I've been a passive investor. I've been passively investing in real estate since 2017. And that's in, different asset classes outside of my core competency as my business with Red Hawk. It's been in multifamily, yes. It's been in some single family developments, but it's been in things like triple net leases, industrial, retail, self-storage, sale leasebacks, some private equity. So also creating some strong income streams from operating partners outside of myself. And I really looked at that as a way to diversify away from myself as an operator. Hey, just in case I screw things up, here's some guys that probably know what they're doing that can kind of balance things out a little bit, but also to kind of participate in some of the markets that are considered the hot markets, if you will, the Sun Belt, Arizona, Texas, where massive appreciation has happened over the last few years, where the Midwest, where I am and feel comfortable operating, is more of a cash flow market. So it's all a balance. But through that experience of investing as a passive investor, as well as an active investor, and getting really involved in the underwriting and understanding what a good deal looks like, that's kind of the maturation process that's led us to starting this fund with the left field investors called InvestWise Collective. And InvestWise Collective is focused on residential debt deals, but also commercial equity deals. And we'll be looking at all the aforementioned passive opportunities and really looking for solid risk-adjusted returns. That's where we feel like there's a gap in the marketplace today. Is yes, you can underwrite. I've always said that math doesn't lie, but spreadsheets do. You can make a spreadsheet say almost anything you want it to, but we want to take apart those spreadsheets and we want to build trust with sponsors that we know have a track record, but also look at it from the deal level and say, okay, in today's environment, does this still make sense? And then provide opportunities for our investors to participate.
So that's fantastic. So this all comes from being able to provide outcomes for your investors and allowing them to participate through education and being able to help them in that way. There's a couple of things that you just mentioned that really come to mind. Like you talked about being able to diversify, but you're really when I hear you say that, it's really about how are you also effectively leveraging the experience and the time of others, right? Because there's only 24 hours in a day. You also talked about the capital that you were willing to deploy when in real estate. So I think that also, when you're listening to what you're saying, it gives some insight into the way that you're thinking about it. But I would want to go something you mentioned before, because as you're someone who's been down a path that you went down already, Paul, it's a path that I went down too, that you are you're in a corporate role, you're successful. You are in the sales and sales leadership roles. Maybe you do or don't have a marketing degree from Miami like you and I do, but that's a kind of whole different thing. The reality is that you said something that I really would like for you to unpack, because I think that I know that there are a lot of people that are listening that are in corporate roles today, that they enjoy their role. And at the same time, they're starting to feel something that you said before, which is, when you know. And I hope that people understood that, because it happened to me too, Paul. And if it happened to me, it happened to you. And I've talked to a lot of other people that it happened to. Maybe talk to what was happening to you when you knew what you knew, and I'm just going to also translate that, which is, you probably know that your corporate days are limited, not because you don't like them, but because there's something else that's going on inside of you that you realize that you can even be able to achieve greater beyond corporate. So talk to us about what you meant when you said, when you know.
Yeah, that's a deep question. I'm glad you kind of brought that out of the spiel I just gave there. I think it's a very personal thing, right? It's going to be different for every individual based on their circumstances, their mindset, their experiences. For me, I think I had always this sort of entrepreneurial bug, and I also had a very limited risk tolerance as far as, and honestly, like a mindset that was more scarcity in nature versus abundant, a limiting mindset, if you will, where I was thinking that I needed to have, somebody sort of direct me in what I should be doing, and not believing in myself fully, really, if I'm honest. And, I was always interested in real estate, probably back as far as 2012. I had considered, okay, I would love to flip houses. That sounds like a fun, idea and a way to kind of match up some skill sets that I think I have and benefit, potential home buyers, first time home buyers. And it aligned with a lot of different things. It was a way to make money, but also add value to society. And that was attracted to me. But I had this like analysis paralysis for like 4 or 5 years and didn't really act on it. And that was a mistake. I should have been more aggressive and just approach things, because you really don't learn things when you read books. You learn things when you get out there in the street and you start to actually make mistakes. And you learn from those mistakes, and you don't want to take massive action or massive mistakes that could lead to big catastrophic collapses, but you want to be able to kind of fall down and then get right back up and figure out how to rise from that and make the mistake more of a launching pad into the next phase of development. And as I look back, and to get back to your question, I was kind of ready for that, I guess, more so at that point. I had reached a point from just a day-to-day standpoint where I would, look forward to the weekend so much, and then Sunday would come along and I'd get the Sunday blues and start thinking about Monday and all the things I had to do, and most of which I didn't really want to do. And that kind of just like kept getting bigger and bigger inside me and more uncomfortable. As I mentioned, my kids were young, and I just kind of saw the writing on the wall that, I wasn't going to be the dad that I wanted to be. I wasn't going to be at their games. I wasn't going to be able to support my wife, who also works and does not want to leave her corporate career. And it would have put a massive amount of strain on her as they got older and got into activities. And we would have had to probably hire a nanny just to keep up with the day to day. And I just didn't feel like that was, right for us in our situation. I saw my management team of my company, and I used to get like into a new role or a promotion would come, and I'd already start thinking about, how can I get into that next position? How can I be positioning myself to get that next promotion in a couple of years from now? And I sort of stopped having that feeling. I didn't want to be any higher in the organization than I was. I didn't want that next level of responsibility or that leadership role. And I saw the people that were in it, and I didn't want their lives. So I guess like all of those things kind of coincided. And I know it's a really long-winded answer to your question, but that's what sort of was going on in my mind. And then I had a little bit of success in real estate, not a ton, a little bit, but I figured, I was 37, I think, at the time. And I thought, I'm not getting any younger. If I'm going to take a chance, now's the time to do it. And what's the worst that could happen? I used to always think about the worst that could happen, and it was like really bad. And in talking with myself and kind of managing through, that sort of theoretical question, I realized that the worst that could happen was that I failed and I would go back into my corporate career and, I'd be fine. So ultimately, those are the decisions that I made, kind of the thought process that I went through over a period of years, and eventually got there.
So the fact that you eventually got there, right? You went through this pattern. I appreciate you sharing it and even teeing it up before, because what's important for everyone that's listening is once again to recognize, like, every single person's journey is different. None of them are the same, but there are some patterns that you start to recognize when you feel like, hey, when it's right for you, and meaning that it's really time for you to start to take the action to get you to whatever the next thing that's been going on in the pit of your gut. You talked about a couple of things, Paul. Like, I overanalyzed things forever. Like, I read books for 4 years. The thing that got me moving is I missed my son's 3rd birthday. And that was the thing. I was like, I'm not doing this again. So although they're different, they're the same. They're the same, right? Because you started thinking about things that were going to happen. I come from a family where we didn't have a lot of financial resources. So I was always scarcity mindset. The little bit that I had, or that we had, wanted to be able to keep that, not spread it around, not lose it, right? It was a very different mindset. Very little to no risk, because I always thought that having money in the bank was the thing that was going to make things better. And so, although things are different and each individual person's journey is the same, like, you're going to recognize when it's the time, and you're going to realize that you probably overthought it way too long. And something is going to happen in your life that says, now I need to take action. But these little things will start to happen, and you'll recognize that it is when, like, you'll know when is the time for you. And you talk to your spouse, or you talk to your significant other, or maybe you're just talking to yourself. But you'll know. And I appreciate you sharing that, because it happens to so many of us that have been in corporate roles forever. And it doesn't mean you're going to quit your corporate role. It just means that you want to start to create another path to getting to live the best life that you want to be able to live. So one of the things that you've also talked about, right? You've been very clear, like, you're not only an active person in investing, like, you're actively investing. You've also honed a skill in passive investing and being able to leverage the two of them. Can you talk about some of the core competencies that you feel need to be present in both the active and the passive investor side? Because that's something that you do very proficiently.
I would say one of the biggest things is patience, and understanding that relationships take time to develop. And I see a lot of people that partner rather quickly, and many times those partnerships work out very, very well. But if you're going to get into a long-term relationship with somebody, whether that's on a passive deal or on an active deal, I think it's important to really understand who that person is and make sure their values align with yours. And also make sure that their skill sets, if it's an active relationship, are different than yours, right? If there were 3 of me, I wouldn't be anywhere farther really from advancing than I would if I had found 2 other people that complement my skill sets and do things that I could never imagine doing, or don't want to do, or would never be good at doing. And that's been really critical to my success, is finding the right people to kind of balance my skills. I think, people that share in your vision are important too. You certainly don't want to, get into a situation where someone is really, really, like, aggressively trying to scale and just buy and acquire, but doesn't have the same criteria as you do necessarily, just for the sake of acquiring. And I see a lot of people that really focus on, number of doors or units or assets under management and things like that, when really, from my standpoint, I'm more focused on simplicity. I'd rather get yield and be get more out of every dollar than just try to stack assets and make life more complicated and have more work to do. So those things are very important to me. So I think, it's a combination. On the passive side, you really have to relinquish a lot of that control, right? You have to trust the sponsorship team to execute on their vision and make sure that vision aligns with yours. Make sure that the deal is within your risk tolerance and fits into your portfolio. And there's a lot of different deal specific metrics that we could talk about. We probably can't get into, but underwriting and just knowing whether or not that underwriting model is accurate, or if it's, whether it's conservative or overly aggressive or realistic based on the marketplace. But really, at some point, you have to relinquish that control and just say, okay, this sponsor is solid. They're in a good market. They have a great track record. They've made all these other investors happy. They've gone through X amount of exits and deals. And at that point, sometimes the deal is very secondary. And it's just like, hey, we can trust this person because they do what they say they're going to do. And there's always risk, but that's about as good as you can get.
And so when you recognize that there are all of these different elements, one of the things that you talked about in the very beginning is it takes time. It's patience, and it's being able to, also have a clear vision of what you want to be able to do, that there's an alignment of values. And so I appreciate you just being able to break that down. But it sounds like whether you're active or passive, you need to have this dose of patience and be willing to put in the work in terms of finding and working with or through those that align with your values and share a common vision.
Absolutely.
As well. We didn't really even, like, one of these things you've talked about this, like, what have you found are some of the best ways to be able to build trust, right? Because I know this is one of the things that you keep coming back to, and you talk about the values and talk about, and maybe some of it's aligned to what you were talking about before, but just thought I would ask you questions, some of the things that you've, or probably better stated, are some of the most effective ways to build trust.
A hot button for me, and one that immediately comes to mind, is someone that does what they say they're going to do. And if for whatever reason they can't do what they said they were going to do, they reset expectations and they're upfront about why whatever they said they were going to do can't happen. And a lot of times there's a really good explanation for it. Or maybe it's something that there's going to be egg on their face about, but they come forward with it and they're honest and they, bring that to light. And I think those are big trust building moments. And for me, like, from a passive investor standpoint, to be in a position to be a fund manager is a fiduciary responsibility, in my opinion. And at this point, we're looking at investing in deals that we have invested in ourselves already, and we've had positive outcomes. And we know that those sponsors and the people that are on their team are solid. They do what they say they're going to do. Whether that's sending a follow-up email with some information they promised over a phone call, or whether that's returning principal within a certain period of time based on the deal metrics that we signed up for. Those are all extremely important sort of bits and pieces and clues into that person's mentality and their values. And if you get enough of those sort of pieces to fit together, you start to build a puzzle and you start to have more trust with that person. And I think that's when, you're ready to take it to the next level. So from my standpoint as a fund manager, I want to make sure that we're investing in deals that I've personally invested in, or know people that have personally invested in, that are within InvestWise Collective, our fund name. So we can, build a track record with our investors based on a foundation that's already there.
Okay. All right. Sounds great. And being able to take that foundation, move it forward. And I also believe I heard you say one of the things was, when things are happening, to be able to reset expectations, provide visibility, and that can also help to solidify trust. But before we actually get into the going long final three, because we kind of have to get into the going long final three pretty quickly.
Let's go.
I want to ask you something just really quickly, because I know you made reference to it a couple of times, but what was the genesis for the InvestWise Collective that you're doing with left field investors?
I think there's a need in the marketplace for capital at this point from a sponsor standpoint. So we're going to try to fill that gap. It's gotten more difficult to raise capital because there has been some turmoil in the commercial real estate markets. We've seen that distributions have been paused on some deals that were overly aggressively underwritten in the last few years. And we hope that we can, through our investor base, bring sponsors deals. So that's one side of the coin. But we also feel that at the same token, that limited partners, because they're passive, some more than others, sometimes are attracted to shiny objects, if you will. You see on an offering memorandum, IRR, cash on cash, equity multiple, and you hear that your friend invested in the deal and it's a go, let's go, green light. There's so much more to it than that. And I think that's where the real value will come in, is if we can look at the deal and break it down into some of the metrics that we feel are critical to being a safe risk-adjusted return type of deal. Take yield on cost, for example. You talk about cap rates and you talk about IRR and all these fancy terms. Well, really what you want is a deal where you can come in and get a stabilized yield. That means after the project is finished, and create a spread between that stabilized yield and the terminal cap rate, which is the multiple you're going to sell the property at. If you can do that, you're going to win. You're not going to lose. So we want to find deals that there's actual value be created and there's a margin of safety above. And I think a lot of passive investors don't even know that term, so I'm going to come in and I'm going to help with some of that kind of stuff. But that's the genesis for it is twofold. There's a need in the marketplace for it from the sponsor side with capital. We feel like we can raise capital, but we're going to do it in a very conservative way. And we're not just going to plow it into deals. We're going to look at them and we're going to break them down and we're going to get our investors into really good, solid risk-adjusted bets.
Fantastic. And then on the other side, it's the working with the investors and the education and being able to help them understand the criteria you have and the things that the different types of opportunities that you are looking into.
That's right. And the idea too is that we intend to bring significant capital into these deals. And through doing so, we hope that we can negotiate better terms for our investors than they would get if they invested directly. And I think that's powerful as well, as to be in a position to offer those types of terms.
All right, fantastic. So appreciate you just giving us a little bit more insight into the InvestWise Collective they have with Left Field Investors. And so here's the thing, though, and I mentioned it already, is we got to get to the going long final three, Paul. And you know what? I never ask anybody, and today you're our special guest. So are you ready?
Let's do it.
I know you were ready, man. This is just a fellow Miami alum with a marketing degree and successful track record. Hey, here we go. All right. Hey, if I can't have fun here, where can I have fun, right? So question number one of the going long final three is, taking a guy who's originally from the East Coast, who's called the Midwest his home. Great choice, by the way, from a guy from Ohio. And I want to bring things back over where this guy from Columbus has actually been living for the last over 2 decades, which is over here in Europe. So I would love for you to share with us, what is your favorite European city, Paul, that you've either visited or is still on your bucket list to visit?
Man, so I had to really think about this one, and it's not like I've traveled extensively in Europe. I've been over there a few times, but I landed on somewhere that I think is close to home for you. And it's not a city, but it's a region. It's Andalusia, Spain. And I went there when I was 16 years old on a 3-week sort of exchange type program in high school. That was the first time I'd ever been to Europe. And it really gave me the bug to travel and make that a core focus of my life, as far as where I get value, as I really like to immerse myself in different cultures and see different things and experience new things. But Sevilla, Granada, the Costa del Sol. I remember a town called Torremolinos, which was super cool. As a 16-year-old, I was in heaven. So that was an awesome experience and a great place for me.
Fantastic. So, and you gave us, so this is typical, right? Overachiever. You give us 3, but I've never heard anyone say Torremolinos yet. So I think it would be kind of cool, if it's okay with you, if we take that as your city.
Torremolinos, it is. I can't say it as well as you can, but
that's okay. I've been over here for almost 2 decades, man. Come on. But yes, so we'll go with that. Awesome. So question number 2, Paul, and it really has to do with, we talked about it before. When you are going out, especially whether you're in a corporate life or you're in the entrepreneurial space, building your own business or working with others, there's always an opportunity to do something even bigger or take the next step. But a lot of times when you're taking action, you can have this objective that is set, but sometimes things don't work out exactly as they're planned, right? And so you get to pay 100% for a lesson because you've either made a mistake, or sometimes people will call it a learning opportunity, however you want to call it. Whatever you set out as a goal did not happen. I would love for you to share not the mistake that happened or the learning opportunity that you had, but what was the lesson that you learned that that whoever's listening or watching us today really needs to hear this lesson so that you can help them minimize the probability of the exact same thing happening to them?
This is an easy one for me, and I think it'll relate to your listeners, because I think a lot of people feel this, but don't realize that, being 90% in stocks and 10% in bonds or thereabouts or whatever it is when you're a young professional, is not diversification. the Fidelities of the world, your Merrill Lynch's, your financial advisors, they'll tell you it is, have a large cap index fund, a mid cap, maybe throw in some international, maybe 10% emerging markets. You're set, just set and forget, right? That can work if you want to retire when you're 60, 65, if you're lucky, 55, by putting money into 401k and just kind of doing what everybody else does. But if you do what everybody else does, you get the results that everybody else does. So if you want to kind of accelerate your wealth building, if you want to kind of step outside the norm and have a life that's a little bit different, that offers you some opportunities that others don't have, you have to take a different path. And when I discovered real estate, which I wish I would have sooner, just all the different benefits that real estate offers. It pays income. It has great tax advantages through depreciation. It gives you the ability to have equity buildup as your tenants pay down your note. It appreciates, and you can use leverage. I mean, all these things make it, that's an acronym there, the ideal investment, if you didn't pick up on that. And, if you can mix that in along with stocks and bonds and other asset classes, precious metals, whatever it is, you really kind of balance out the volatility of your portfolio, but you have outsized gains too. And that's been my experience. And, I would encourage everybody to kind of challenge the thesis that the 90-10 or the 60-40, if you're a little bit older, portfolio is in fact actually diversified, because I got crushed in 2008 when I was, all in on stocks. I felt the pain in my portfolio in 2020 when COVID hit, but to a much lesser degree because I was in real estate and it didn't burn nearly as bad.
Yeah, that's appreciate you sharing that perspective and diversification. You even talked about it earlier. You're diversifying across areas or assets that you actually specialized in terms of knowledge. So just leveraging the efforts of others. And so I really appreciate you sharing that perspective with us. And then lastly, and I know we've talked about education a lot, Paul, but one of the things that I always love for you to help us go away with is, what are some of the things that you consider knowledge that we can put in our head in the form of a book? So what is one book that you would recommend to the Go Along family today?
It's a book that I read probably 6-7 years ago that I've recently picked up again. It's called The Creature from Jekyll Island by Edward Griffin. And it's a history of the Federal Reserve that goes back to its creation in 1913, but it actually goes back much farther than that. It's a powerful sort of lesson builder, if you will, and the fact that it exposes what's really going on behind the curtains. You can listen to the Federal Reserve, which is one of the most powerful, I want to call it a cartel in the world. That's what the book refers to it as. Yep. But if you listen to what they say, what Jerome Powell says, what the newspaper articles say, it will misdirect you in your sort of journey and what you think you should be doing and not doing. If you follow history and you apply it to today and what's happening in today, and you take those lessons from the past and plug them into those news articles, you get a much better sense of where we might be headed. And through that process, I've kept myself out of a lot of trouble and actually created some benefits. So I would encourage everybody to read that book. It's on monetary policy, and it's written in the sense that it's not so dry that it's going to put you to sleep. It's actually very, very interesting stuff.
Thank you very much for mentioning that. And that's probably the book that I recommend the most, without a doubt.
Is it?
And yeah, without a doubt. And it is like, so if anybody's watching the video version, like when Paul was just talking, I was kind of pointing over my shoulder because I'm going like,
I was wondering what you were pointing at.
Yeah, there it is. Always keep that one nearby. That was the one that actually changed a lot of things for me, gave me a very different perspective in terms of what was happening. Not just what I was seeing on the news, but really what was happening. What are some of the things that I should probably be paying attention to in the way that the currency game works? Because I call it money. Anyway, we won't get onto that whole different. That's a whole different podcast. But yeah, so you know what? I was just thinking to myself, like, you've answered all these questions, and these conversations literally just fly by. I'm thinking about in the very beginning, you're talking to us about, some of the most positive things that have happened. And you talk about what was, what you inked, if you will, with the InvestWise Collective, with Left Field Investors. And you talked to us a lot about the 16 years that you had from marketing, sales leadership. You talked to us about being able to also work in different industries, talking about the experiences that you had in your healthcare, successful corporate, but then you also realized that you knew when it was win for you, right? And you talked to us, you were able to break that down and give us some more insight into recognizing that this is something that's going to happen for every single person in a different way. But there are also some areas that are going to be very similar. That you're going to realize that there are things that you want to do that go beyond just your corporate role, that there are things in your life and events in your life that you are going to want to participate in and be present for. And so now you've walked the path. You've been able to leverage both your passive investing, your active investing. You've talked about some of the specific strategies like Burr that you were using in the beginning. You're also talking about some of the different ways that you are leveraging the efforts of others as a passive investor, and also how you're helping others as an active investor. And whether you're doing that through Red Hawk Real Estate, or whether you're doing that through the InvestWise Collective with LFI, Left Field Investors, these are all the things that people were like, hang on a second. So I'm just going to ask you the question because everybody wants to know. They're like, Billy, stop talking about all this stuff. Listen, Paul, what is the best way for the Going Long family to find out more about you, what you've got going on, and how we can continue to learn from you?
Well, Billy, I just want to say thank you so much for having me on. You're a fantastic host. It's been an honor to be here with a alumni of the university that we both attended. But it really has been an honor and it's been a pleasure. So thank you. And thank you for giving me the opportunity to tell people where they can find out more about me and us. My website is redhawkinvesting.com. That's where you'll find information on our single family deals, our multifamily properties, as well as some information on the InvestWise Collective that we're just getting up and going, the fund. I would encourage you to check out the Left Field Investors group as well. I am not directly a part of that group. I am an infielder, if you will. So I'm a member of the community, but also now a partner of theirs. But just a fantastic platform they have over there and a great way to kind of learn and network with other passive investors. And then where I share a lot of opinions and different things that are going on in the market and just have a lot to say is on LinkedIn. So if you want to connect with me on LinkedIn, Paul Shannon.
All right, fantastic. So check him out, everybody, on LinkedIn, redhawkinvesting.com. Also, just reach out to him. He's an awesome guy, and appreciate the kind words. And yes, both alumni of Miami University. So there you go. Listen, Paul, on behalf of the entire Going Long family, man, I just want to say thank you very much for deciding to invest your time with me and investing your time with us. Thank you.
My pleasure, Billy. Thank you.
All right, cool. Give me literally like 15 seconds. I'm going to wrap things up here really quickly. Mm-hmm. Going Long family, listen, I mean, he's once again, he has talked to you and shared some very specific examples of what his life was like in corporate, how he moved from corporate to being able to move towards the life priorities that he had, leveraging the efforts of others and the expertise of others, and also being able to continue to educate others. Take today's conversation, share it with one or two other people, like just one or two. It's very simple. And then get on the phone or meet up with somebody and talk about the concepts that Paul has shared with you today. Move from theory into practice. That way is when that's going to help you to get in the game and get closer to the life and the life design that you're really looking to build and live. So while you're doing that, I'll be here preparing for the very next conversation. So until then, go out and make it a great day. And thank you very much.